Get ready because the news cycle is moving at warp speed and you need to stay ahead. Welcome to Qualcomm Pulse, where we break down the biggest stories that matter to you. We've got a packed show today, with updates that could reshape industries and redefine the future. From massive revenue streams to unexpected market shifts, you won't want to miss a single second of this. Let's dive in. First up, a seismic revelation from a tech titan that has everyone talking. We're pulling back the curtain on who's really driving the engine, and the numbers are staggering. How much revenue can one company realistically generate from just a handful of clients? We've got the details that could have major implications for your investments. Get ready for the deep dive. Then, we're shifting gears to the global stage, where policy decisions are creating ripples across markets. A major ruling that could shake up international trade and the companies that depend on it. Is this the end of an era, or just a new beginning for global commerce? We're breaking down the impact and what it means for the players involved. Next, we're going back to the giants of AI, because the story just keeps getting bigger. It turns out that even more of their success is tied to a select few, and we're uncovering the specifics. What does this concentrated power mean for the future of innovation and the companies vying for a piece of the pie? We've got the inside scoop. And finally, we're looking at the broader market picture. What's really moving the needle, and what are the underlying trends you need to be aware of? We've got a snapshot of where things stand, and it's crucial information for anyone navigating today's fast-paced financial world. Stay locked in, because this is Qualcomm Pulse. Don't forget to like, subscribe, and hit that notification bell so you never miss an update. Concentration shock, Nvidia's revenue reliance exposed. In a stunning disclosure that has sent ripples through the investment community, Nvidia has revealed that a mere 2 clients accounted for a staggering 39% of its total revenue in the second quarter of fiscal year 2026. This means that approximately $18.2 billion of the company's $46.7 billion in revenue originated from just these 2 unnamed entities. This level of customer concentration has seen a dramatic increase, jumping from 25% in the same quarter last year, raising significant questions about the stability and future growth trajectory of the AI chip giant. The identities of these crucial clients remain a mystery, with Nvidia classifying them as direct customers. This designation implies they purchase chips directly from Nvidia to build systems or circuit boards, which are then subsequently sold to end users like cloud providers or large enterprises. Such direct customers can encompass original equipment manufacturers, OEMs like Dell Technologies, or contract manufacturers like Foxconn, rather than the ultimate cloud platforms that house and utilize the chips. This distinction is vital, as it means the revenue flow is through these intermediaries, not directly from the end users of the AI power. Nvidia's business model, particularly within its dominant data center segment, which comprised 88% of its overall revenue, is heavily influenced by these major buyers. Chief Financial Officer Colette Kress stated that large cloud service providers represented about 50% of the data center revenue during the quarter. These indirect customers, such as Microsoft, Amazon, Alphabet's Google, and Meta platforms, are the ones driving the insatiable demand for AI hardware. However, their substantial chip requirements are often channeled through the aforementioned direct customers, adding a layer of complexity to Nvidia's sales structure. This concentration presents a double-edged sword. On one side, it underscores Nvidia's indispensable role in the burgeoning AI revolution, catering to immense demand from hyperscale cloud platforms and emerging markets like foreign governments. The company's forward-looking guidance of $54 billion in revenue for the current quarter signals robust ongoing demand. Yet, the flip side is the inherent risk. Any fluctuation in orders, any shift in spending priorities by these few key clients, or even a strategic change in their chip sourcing could have a disproportionately severe impact on Nvidia's financial performance. Chief Executive Jensen Huang has projected a massive global spend of $3 trillion to $4 trillion on AI systems by the end of the decade, indicating a vast market opportunity. But Nvidia's current revenue structure highlights its dependence on capturing a significant portion of this through a limited client base. Analysts are closely monitoring this dependency as a key factor for investors to consider. While Wall Street remains largely bullish, with 34 out of 38 analysts rating the stock a buy and an average price target suggesting a 21.7% upside, the concentration risk cannot be ignored. The market is left to weigh the undeniable growth driven by these major clients against the potential volatility introduced by relying so heavily on their continued patronage. Hold on tight, because the story of concentrated power in tech is far from over. Next, we're heading into the arena of global policy and its unexpected market consequences. Tariff tussle, policy shift, and AI stock jitters. As the market navigates the complexities of global trade and economic policy, a significant ruling on tariffs has emerged, potentially reshaping international commerce. A U.S. appeals court has declared most Trump-era tariffs illegal, a decision handed down late Friday. This development comes amidst a strong stock market rally that saw the S&P 500 reach new highs through Thursday, but it was followed by a noticeable retreat on Friday, particularly impacting AA-focused stocks. The implications of this tariff ruling are far-reaching, affecting the cost of imported goods and the competitiveness of various industries. By deeming the tariffs illegal, the court decision could lead to adjustments in trade agreements and potentially lower prices for consumers and businesses alike. However, the immediate market reaction suggests a degree of uncertainty, as investors digest the potential economic shifts and the impact on companies with significant international supply chains or export markets. The rally had been fueled by optimism surrounding economic growth and technological advancement, but this legal challenge introduces a new variable into the equation. Simultaneously, the artificial intelligence sector, which has been a primary driver of market gains, experienced a downturn. Nvidia, a bellwether for the AI industry, saw its stock retreat. This decline occurred despite the company's strong performance and optimistic outlook, highlighting the sector's sensitivity to broader market sentiment and macroeconomic factors. The ruling on tariffs, while seemingly distinct from the AI boom, can influence the overall economic environment in which these technologies operate. For instance, changes in trade policy could affect the cost of components, the accessibility of global markets, or the overall demand for technology products. The market's sensitivity to these interconnected factors is evident. While the AI plays led the charge, the subsequent pullback indicates that investors are also factoring in geopolitical and regulatory risks. The legal challenge to tariffs could set a precedent for future trade disputes and influence how businesses approach global expansion and sourcing. Companies that rely heavily on imported materials or export significantly to markets affected by tariffs will be particularly attuned to these developments. The ruling may also spark discussions about the effectiveness and legality of using tariffs as a trade negotiation tool. Furthermore, the news about Alibaba hitting Nvidia suggests a dynamic interplay between major tech players and the broader economic landscape. While the specifics of this interaction are not detailed in this particular snippet, it points towards the complex web of relationships and competitive pressures within the technology sector. Such news, combined with policy shifts, creates a volatile environment where strategic positioning and adaptability are paramount. Stay tuned as we delve deeper into how these policy shifts could reshape the global economic landscape. Next, we're returning to the data centers to uncover even more about concentrated customer bases in the AI powerhouse. AI's triple threat: 3 clients dominate Nvidia's data center revenue. Imagine a scenario where a significant majority of your company's most lucrative divisions' sales come from just 3 clients. This is precisely the situation Nvidia finds itself in, as revealed in its second quarter earnings for fiscal year 2025. The report indicates that nearly 53% of the revenue generated by Nvidia's data center division, a segment that is the powerhouse of its business, is attributed to 3 unnamed customers. This concentration amounts to a colossal $21.9 billion in sales from these select few, painting a vivid picture of the company's reliance on its top clients. Breaking down these figures further, we see that customer A is responsible for $9.5 billion, customer B for $6.6 billion, and customer C for $5.7 billion. Considering Nvidia's total second quarter, revenue hovered around $46 billion. It's clear that customer A alone accounts for over 20% of the company's entire sales. This level of dependency, while indicative of strong demand from these major players, also presents a significant risk. Should any of these key clients decide to shift their allegiance, perhaps by developing in-house chip solutions, opting for competitors like AMD, or facing unforeseen operational challenges, the impact on Nvidia's cash flow and overall operations could be substantial. While the immediate future appears stable, with investor sentiment remaining bullish on AI technology and Nvidia's competitive technological edge seemingly unassailable, the long-term implications of such a concentrated customer base are a valid concern for executives and stakeholders. The reliance on a narrow foundation for such a colossal enterprise is a strategic vulnerability that could keep leadership awake at night. Speculation is rife regarding the identities of these mega clients. Industry observers point to prominent figures and ambitious projects in the AI space. Elon Musk's xAI, with its record-breaking deployment of 100,000 Nvidia H200 GPUs in just 19 days, and ambitious plans for 50 million H100 equivalent GPUs within 5 years, is a strong contender. Similarly, the collaboration between OpenAI and Oracle to build a Stargate data center requiring over 2 million AI chips further highlights the scale of demand from major AI players. Meta Platforms, under Mark Zuckerberg, is also making significant investments in AI infrastructure, planning several multi-GW clusters, which undoubtedly translates to substantial chip orders. Interestingly, this concentrated revenue stream could also explain Nvidia's complex position in international trade dynamics. Despite facing challenges with sales in China, including an initial ban on its H20 chip by former President Donald Trump and subsequent directives from Beijing, the company's substantial sales to these 3 major clients might provide a buffer. This situation could be why CEO Jensen Huang is frequently engaged in high-level discussions between Beijing and Washington, with Nvidia potentially serving as a pawn in the ongoing global trade negotiations. This deep dive into Nvidia's client concentration reveals a powerful, yet potentially fragile, business model. Up next, we'll look at the broader market indicators and what they signal for the days ahead. Market Pulse, navigating data delays and key indicators. In the fast-paced world of financial markets, staying informed requires timely access to crucial data. However, the landscape of market information is often characterized by varying degrees of delay, impacting how traders and investors make decisions. Understanding these delays is key to interpreting market movements accurately. For instance, certain stock exchanges, like the Cboe BZX, provide real-time data, which is invaluable for high-frequency trading and immediate reaction to market events. In contrast, other data feeds, particularly for futures and forex markets, may have a 10 or 15-minute delay. This delay, often implemented due to the sheer volume of transactions and data processing requirements, means that the prices and information available are not instantaneous. Market data is often consolidated from various sources, reflecting broader market activity rather than a single exchange's real-time feed. This delay is a critical factor for investors to consider. While a 15-minute delay might seem insignificant, in highly volatile markets, it can mean the difference between entering a trade at an optimal price or missing the opportunity altogether. Fundamental data, provided by specialized services like Zacks and Morningstar, offers deeper insights into company performance and valuation, but this information is typically historical and requires analysis to project future trends. The reliability and timeliness of this fundamental data are crucial for long-term investment strategies. The mention of specific delays, such as the 15-minute delay for futures and forex, underscores the operational realities of financial data dissemination. It highlights the infrastructure and technology required to manage and distribute vast amounts of financial information across global markets. The consolidation of market data also points to the interconnectedness of financial systems, where information from different exchanges and asset classes is aggregated to provide a comprehensive market overview. Understanding these data nuances is not just about technicalities. It's about grasping the real-time dynamics of investment. Whether it's the rapid-fire trading of stocks or the longer-term strategic positioning in currencies and commodities, the speed at which information is received and processed directly influences outcomes. The reliance on providers like bar chart solutions for market data and Zacks and Morningstar for fundamental analysis shows the ecosystem that supports market participants. Ultimately, this information serves as a reminder that while technology drives market access, there are inherent limitations and variations in data delivery. Investors must be aware of these factors to make informed decisions, leveraging the data available while accounting for any temporal discrepancies. The continuous evolution of data technology aims to minimize these delays, but for now, awareness and strategic adaptation remain key. This overview of market data realities provides crucial context for interpreting financial movements. We've covered a lot of ground today, from corporate revenues to global policy and market data. What's next is a quick recap and your call to action. And that's a wrap on today's essential updates. We saw Nvidia's revenue concentration hit a new high with 2 clients making up 39% of sales. Then, a major court ruling declared most Trump tariffs illegal, potentially shaking up global trade, while AI stocks saw a dip. We also learned that 3 customers now account for over 50% of Nvidia's data center revenue, highlighting intense client reliance. Finally, we touched on market data delays, a crucial factor for smart investing. Loved this breakdown? Smash that like button, subscribe to Qualcomm Pulse for more, and ring the notification bell so you don't miss a single update. Follow us on all social platforms for more insights, and drop a comment below telling us what you think about these massive market shifts.